rate than we've come to expect. And that is because we've left what we refer to here as the great moderation. And we've had 40 years where certain things have been happening that have now changed and stopped. And they stopped really around COVID, and we call COVID the great financial shock to the system. And the three major things that we've heard about but aren't paying enough attention to is globalization has slowed and in many ways starting to reverse. What delivered was labor arbitrage, cheap commodities, and that drove down our costs. The second thing we've had financialization. And what that has been about is falling rates, falling interest rates. And that has been steadily since Volcker in 1980 tapped them out at around 19%, and we ended up at the zero bound. You can't go much lower than zero on nominal rates. So that is also reversed. And the third thing is mercantilism, and that is where Japan originally and China take all their money invested back into US bonds. And by doing that, they drive interest rates down, the volume of the bonds up, so you get more collateral for the bonds. Consumers can spend more money, they spend more, buy it from China, our debt goes up. Japan and China are masters of that, and it creates a stronger dollar, which has created consumption. All three of those are now reversing. And we're coming out of the other side of the moderation, of this great moderation. And when the bottom line of that is that this is one of the things we're watching for, is that debt is changing and equity is changing. And by debt, I mean the high bond duration risk premiums are going up. So it's the pricing of risk is going up. So in bonds, it's the duration bond risk premiums are going up. You can see that. And in equity, it's the equity risk premiums that they're higher. So inflation, Adam, if you think of it. So even though right now the market is going up, we're going to turn around and we're going to see a deflationary impact, but at the same time, inflation. We're actually going to have both, but in different areas. We're going to see deflation in assets, but we're going to see inflation in everything that you need.
Right.
That you have to on, and you have to pay cash to that you don't finance. It's tough to finance your grocery bills. And credit is through the roof. Credit managers are tightening it in, are very much tightening it right now. Nothing I'm not telling you. The issue is they're already doing that real squeeze on the consumer that's going to accelerate. It's what's going to hit is when their credit starts to really squeeze them, and the credit being to finance those credit cards that I mentioned earlier. But what's happening underneath this is that we will fall into a recession historically. A close friend of mine, credit net credit at 2% per year on an annualized real rate, we fall into a recession. And we're well below this and have been sustained for a period of time now. The real rate of credit is just not large enough. So what it's saying is we don't have the ability we're not increasing credit at a fast enough rate in the United States to support the GDP that we need, or we fall into true stagflation. And the problem behind that is the worry about collateral. And as you mentioned, housing down in 2008 was when the prices of the houses started to fall. All of a sudden, PMIs, private mortgage insurance, were up, or you had to ante more money. You couldn't do it, down went the prices. Well, now the market is really right now worried about the stability of the consumers' not ability to lend more, but is the current collateral that they're using strong enough? Big part of that is they're assuming certain wages are sustained. That's an old problem. It's been with us for a long period of time. But at an economic level, it's going down hard and fast and deep, okay? And you may not be on board, but you're better to try and get on when it starts to happen and it starts to go down. And here's the killer on this. Even when that happens, we're going to hit a bounce and it's going to go back up as we get into hyperinflation, as we print more money, because it's the only solution these politicians know how to do is liquidity. Keynesian pump more money. We'll turn around and it'll start to shoot back up. It'll be violent counter rallies, violent, even though I'm talking about going down. S&P 4,200, maybe 4,300. That's the range we're in right now. So if it's going to go higher, we're a little skeptical, but it could very much so. But then we're on our way down, and we think that's going to take us down to maybe 3,200. We've had 3,170 for a long time. Maybe it could be as high as 3,500. Then we bounce back up, and that bounce back up end of this year, going into next year, will be as we stop quantitative tightening. That will end. That we start to reduce rates. We'll have the pivot. We'll start to put it back in if inflation isn't rebounding, and then that'll start to drive the markets up. What will slow it quickly is inflation has not gone away. It comes in three waves. Energy wave, we'll see it. Food wave, we've got three more waves of that. And we did history going back to World War I, overlaying all of this. Instantly, you see it, and when you get over what we call 5%, historically, over a 5% in a sustained fashion on inflation, the ramifications of that go through the economies start to show that, because inflation is very sticky, it usually goes in about three waves. It may not be three waves, but it goes in waves, kind of like COVID. And those waves will push back inflation, and away we'll go. We'll have this volatility. And suddenly the whole issues with more quantitative easing aren't working. They're working against us. So it'll be this mix up in monetary policy, but the way they'll fix it is just hyperinflation. They'll print in some fashion. They'll print the money, and print the money is, I got to be really careful. People don't misunderstand. They start guaranteeing credit. They start. I say that because we focus this conversations on the national debt. It's 31.4 trillion. Theoretically, it's not 31.4 trillion dollars. We have $64 trillion in unfunded liabilities associated with Social Security, right, Medicare, all in our paper. It's got to be funded. How are we going to do that? Print more money? Big problem. And that's coming due. That is really frightening in how we handle it. And there's ways that are. Right now, we're basically more or less neutral, if not in bonds, but our strength, what we have been playing very much longer term, is the whole realm of commodities at various levels. We think hard assets as measured in the commodities, especially if you're laying your money in US dollars, is a strong area to give a lot of consideration to. It's going to be highly volatile. So have like things like gold, 25%, 30% corrections. No, right from the raw producers, depending on the countries and the commodities, up to how it's eventually traded and how it's moved. It's even into shipping and how it's moved, whether it can stay in the countries. The whole investment of a shift from now, we're moving away from web-oriented companies, call it Web 2 to Web 3. The Amazons, the Facebooks, all these technology companies are going to be around, but they're not the play anymore. We're in a different world where it's monetary driven, and what's real value in the store of value. And it's not as simple as saying, oh, I got to be in hard assets. It's commodities and a type of commodities. Food is another commodity, soft commodities. What type of food? How's it processed? These are where we believe, and I don't give investment advice. I'm just telling you what we do. We spend a lot of time tearing apart this now. Well, and when we see corrections, we add to our position. Money managers picking stock pickers, picking sectors, understanding them, and drilling down and being able to pair it apart. So picking your money manager who really understands this is absolutely critical. I believe that will eventually start to move into the whole different types of ETFs will be on. Okay, and it won't take long before people will start to figure that out. But if you've got a good money manager and is helping you manage it, that whole as that unfolds and then more capital, how you transition is still in the future. So you need people that have not seen tough times in credit. Markets follow the currency markets, they follow the credit markets, they follow the bond markets. Equities like the tail on the end of the dog. And we have too few people that only pay attention to the charts on the equity markets, and they're up and down, and what's the VIX, and that's what all the markets, how they work, how they're dynamic. And if you can do that, you're not playing with matches, you're investing. And right now, I would say they're not matches. There's a difference between investing and gambling, and we have too many people out there who are gamblers, and you don't